Good afternoon or good morning, depending on where you're joining us from in this world. And welcome to episode 11 of the AI Circle with Kelly Korshak. I am your host, of course, Aaron Yoon. I'm the product manager here at iFlip. And joining me is none other than Kelly Korshak. Welcome, Kelly.
Hello, Aaron. Good afternoon.
Little bit of a hectic start because I'm still getting used to this new platform that we're using over here. But it's good. I'm learning each week that we do this. I'm getting a little bit better, right? And that's all you can really hope for. Um, but before we can get into any of the fun stuff, we have to go through everyone's favorite part, which is the disclosure. So please bear with me as we go through this disclaimer. iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, I'm going to pass it on over to Kelly. And please, this is the last AI Circle of January. Can you wrap up the month for us?
Absolutely. By the way, it was a hectic start to the day as well as our webinar here.
Yeah.
Um, I think since the month is not quite over yet, and I think it ends next Monday or Tuesday, I think that January is going to be as a continuation of our last AI Circle 2 weeks ago. It's going to be a good month. Unlike last January, which it wasn't, this January is starting off very well. Aaron, I would like to share my screen. Is that okay?
Yeah, absolutely.
Here I go, everybody. Hopefully, everybody sees the computer screen that's up right there. And we can see this is a chart of the S&P 500. Here is last January, the end of the year of 2021. And as we saw, last January was very tumultuous. And we, at one point in January, were all the way down as much as 10% in a month. Just right off the bat, that was not obviously a good start of the month where it could lose as many as 50 S&P points, which is more than 10, almost 10% for the month after rallying back and then making new lows throughout the year. Where we bottomed in October. But let's look here, folks. It's a brand new year. It's 2023. And we can look right here and we can see that the market bottomed at the end of December of last year. And in January, it was holding on. And we've more or less had a nice little breakout to the upside. And now this is a 200-day moving average. If you guys can see it clearly, this orange line, we are actually starting to have some solid closes above it. As a matter of fact, if everybody's kept close, the S&P 500 spider has closed at exactly 400, give or take $1 for the last 3 days. So that's several closes above a 200-day moving average. Generally portends to show for advanced pricing. In other words, should go higher. Now, by the way, this morning, we opened up because we had bad news from Microsoft. But the market spent the whole day recovering. Generally, after the first hour of the day, the market was in recovery mode and actually turned marginally higher on the day and closed off of its low and on its high. And of course, today we did get our signal that we were anticipating, and we are all now long the S&P 500. So if you are a Flip user and you have the spider in your account in a Smartfolio, that particular item will be long. So we sent out a lot of orders today, and we own the S&P right in here. Tomorrow, to be able to give you an idea where the end of the month could look, tomorrow is a plethora of data is coming out. We have everything from claims over here, jobless claims. I have durable goods. I have capital orders. I have Chicago Fed. I have home sales, jobless claims. So tomorrow, as of 8 in the morning, market opens, we will be getting a lot of data going to create volatility. When I see this, just as a disclaimer, it's, when you see a market close on its into numbers, me that the hating good news. These numbers about anything looks decent and or marginally bad, the market will rally tomorrow, and it should be significant. So let's hold me to that one as well, everybody, and let's hope that my forecast for S&P 500 in the short first by January and even February, we rally all the way up to the 420 level, which I expect is right about over here. So that's what I think is coming in the next couple of weeks. If so, that looked to me approximately a 20 over 400, about a 6% rally.
Kelly,
I think short run.
Yeah. Sorry, Kelly. I had to jump in here because it seemed like I'm not sure if everyone else is experiencing this on the stream, but it was cutting in and out, and it seemed like we were having a little bit of a bandwidth issue. So usually when that happens, I take the screen share off. So because your comments are way more valuable than the chart that we were seeing on the screen that started to get blurry because of the bandwidth issue.
Okay.
So I am going to ask you to kind of recap that again a little bit without the screen share this time, because I think you said a lot of great things in there.
All
Um,
right.
what came through was that you believe that the market is going to rally tomorrow, but I'd like you to answer this question, but from a kind of a different angle, because this is something that we were preparing to talk about today, and this is one of the questions that I think a lot of the people watching would be interested in. It's on the screen. What did the AI see exactly that had the iFlip AI go long today of all days, despite the Microsoft scare and the kind of the range bound price action that we've been seeing recently?
Well, actually, from the AI didn't really see anything in this particular case.
Okay.
Let me advance this a little further. Last week, we had the way our product works is we have a set of algorithms that do basic money management and certain kinds of entry signals and exit signals. Behind that is the machine learning / AI component that actually builds other algorithms that are pushed into our operating algorithm. And what happened today, or actually last night, was the AI gave the go ahead for the pricing algorithm to take signals. Just last week and most of last year, the AI was prohibiting all kinds of algorithmic signals to buy into the market because the AI had a lot of data that said it was bad. For example, credit card defaults, auto loan defaults, Fed funds rates, et cetera, et cetera. Expectation on the Fed funds rate as measured by the S&P 500 futures, things like that are what the AI looks at. And right now, my belief, if I'm trying to pinpoint it, is the AI signal that would prohibit an entry long into the market based on based on the Fed funds futures rate, which is another component, is now saying that the hike that we expect the Fed to give in early February is only going to be 25 basis points. And that moved down from 50 basis point increases to the expected 25 basis point increase, actually pulled a trigger away from the machine learning component, is what I suspect. because it's, remember, it's machine learning, not me, and it pulled the signal to abort the algorithmic signals away. I know that's very complex. At the end of the day, let me say it this way: the machine learning is now allowing other kinds of trades to be affected, and they are no longer prohibiting it. So, at least in the short run, and that's why I mentioned last AI circle, the AI is starting to show more friendliness, and it did literally today. Just last week, we had a very similar signal that the AI did not allow to occur. But this time it did. It was that close. Literally, 5 days made the difference. And that's the difference between machine learning and me. I suspected it. That's why I warned everybody 2 weeks ago that we could be getting long. And it took literally till today to do it. Did that come in nice and clear, Aaron?
Yes, that came in so much better. I think, sound off in the comments if you guys followed that. That didn't cut off or get blurry or anything at all. So if I'm understanding it correctly, it's like the algorithms are like foot soldiers that are itching to get into battle, that are itching to buy, and the AI is kind of like the general that says, "Well, hold your horses. The battle conditions aren't correct yet." Right, so it's a waste to get in now, and they it kind of like holds it back until today. Is that correct?
That's a decent metaphor. They're actually working together. There's, again, the machine learning AI component builds its own algorithms. And those algorithms create buy and sell signals. Get in here, get out there, get in here, get out there. That's what the AI does.
Okay.
But the way it signals is to say get in or get out. It also has a signal to say you're not in the market, stay out. So it's either stay out or be in or get out. For most of 2022, it was stay out. However, in the first 2 weeks or almost 3 weeks of 2023, I could see that signal was waffling because
Ah,
there's other AI algorithms that are very successful that were starting to show long signals. Not the one we use, but other ones did. Not as robust as the one we use. They were starting to show a buy signal was imminent. That's why I suspected the one we use was going to work as well. And we also have this, we have the algorithmic signal. Generally, you can't see it on the screen because I've taken that off, but generally, we want to be in the market when the market is showing movement above a 200-day moving average on the S&P 500. And it's finally confirmed that. So this here, everybody, is a algorithmic signal that occurred. Last year, there was plenty of times that the AI held us out of a signal to buy when the market was above the 200-day moving average, for example, but it wouldn't allow us to. This time it did. And like I said, I suspect that it came from the Fed futures, the Fed funds futures information that we feed into it that waffled. That's what I suspect. I'll never really know. I can't know that unless I rerun it without the Fed futures data and see if it made a signal.
right.
So, and that's just too difficult and it's not necessary. So the bottom line is, everybody, we're in the market, and that means we're probably with an expectation of 420 on the S&P spider, and with a very low risk trade, maybe only down to about 394, which is only about 6 points down and 20 points up. That's a very good risk to reward bet. So let's hope that the information tomorrow comes out well for all of us, and know that tomorrow is a big day, because the amount of information that is coming out tomorrow is massive, and it will move the markets.
Can you get into that a little bit, because that's kind of where you cut out before? You
Yes.
mentioned something that if something happens tomorrow, that the market will rally, and it will
Yes.
rally significantly. Can you repeat that part, please?
Oh, of course. Look, tomorrow, Thursday, like in almost all months, the Fed reports information in various ways, and also other agencies of the government. Tomorrow, for example, real gross domestic product comes out, GDP. Um, we also have we have new home sales, Chicago Federal Reserve, durable good orders are also coming out, jobless claims are coming out. So when you see all of this data coming together in one day, in other words, a lot of information that drives the markets are driven fundamentally at the end of the day. A lot of fundamental information is coming out that the AI will read. The AI doesn't know that that data is coming out. However, the market does. And the market today opened down, probably in the fear that that data could be bad, but they rallied it up on the day, which means they don't care. They expect and want good data. So therefore, it generally tells me through my experience, for what this is worth, that tomorrow may have all kinds of data, but the market wants to interpret this good in a good way. And if any of this data is anything less than terrible, which means decent, the market will rally significantly. The only way the market goes down tomorrow, in my mind, just as a person that's watched this, is some of these numbers are all just devastating numbers and they all miss expectations. But based on the close I saw today, my bet is long, 60-40. So it's a bet you want to take. Here we are,
Awesome.
folks. So if I was a trader short term, I would be telling you to probably buy 410 calls on the spider for February and play that game. But right now, we just got into the market, and I suspect we're going to hold this trade generally somewhere around a month or so, if we can, to see where the market takes us.
It's not every day that you get an options tip here on the AI circle, but if anyone understood that, if any of you options traders are out there, let us know. Sound off in the comments section if you're thinking of that based on what you've heard today. Obviously, none of this is advice. We went through that disclosure already, but let us know in the comments how you feel about a 410 call on the SPY. For what was the date that
February.
you called for the
February.
February? Yeah. Okay, so sound off in the comments. Let us know what you think about that. Now, that begs this question, though, Kelly, and we'll get to the trivia question for tonight after this. So get your keyboards and your phones ready. Um, I gotta ask the follow up question: are you still predicting new lows by Q2 and Q3 like you did before?
Yes, that's still possible. The main thing that matters is, again, the personal opinion is my own. I feel that the data that is coming out may well indeed be bad, but it may not be as bad as expectations. The market always wants to basically under promise and over deliver. And that's just the nature of it. The market always wants to say in stocks when they report that they beat expectations and they rose 1 penny. So they'll say, we think we'll have earnings of 3 cents, but they really show 4 cents. They always try to beat by a penny. And the analysts do it that way on purpose so that they under promise and over deliver. That keeps a buoyancy in the market. That being said, I think, again, the opinion is my own, that the layoffs will be significant and it could create a deeper unemployment than we think. And I also think that will slow down consumption. And America, of course, at the end of the day is driven by consumption. And if we have more people on the unemployment rolls, then that is definitely means that spending will be cut back. And that's why earnings are going to cut back. And that will take its toll maybe by late February, March, April. So the jury's not in for a bull market for 2023, but we're off to a good start because I think at the end of the day, the data, they know it's going to be bad. We all anticipate that. But you know what? When we all anticipate something, it probably means we probably should look the other way and at least entertain the thought. And that's what I was trying to point out. And I think my previous two AI circles, I remain bearish. But as I said in the last AI circle, I'd rather be a nervous bull than a staunch bear.
Yes. Yeah, we actually had that's actually the title of one of our YouTube videos from that segment. A confident no, a nervous long versus a confident short, right? Which and we explained the difference between the two from uh last session's AI circle. So if you like and subscribe to the channel, and you can find that video in our playlist. We will
Aaron, it also points something else that also really must be observed as well. Everybody remember also Bitcoin. It was, remember, we talked in the last AI circle, it was sitting around 17,000 for quite some time, most of all December. It is now sitting at 23,000. We're up almost now, at the last time, percent, now almost 40%. There is no 40% rally is meaningful. Bitcoin has rallied a great deal more than the stock market. This market, according to what I'm seeing, is very close to a breakout to the upside. My call on the last AI circle was 30,000, 28 to 30,000, and I remain confident that we will get there in the coming months. And actually, maybe even 1 month from now. That is a significant move as well. It means that the contagion that we expect is also being ignored. Even unemployment and future job cuts and layoffs is also being ignored. There is something going on in Bitcoin that tells me we have higher prices to come. Now, we might have some short-term resistance at 25,000 area. However, should we push through there, you can bet 30,000 is very realistic.
Thanks for that, Kelly. That's yeah. I had forgotten that we had that Bitcoin conversation the other day, and I wanted to bring that in too. But thank you for reminding me. We're about to get into the trivia section to close out this AI circle. But this trivia question, the question for tonight is somewhat unique, and I'll explain after I ask it. So once again, if you were just kind of passively listening and you're just doing this thing like a podcast or anything like that, now's the time to stop what you're doing for a few minutes, really engage, pay attention, and get ready to type in the answer to the trivia question in the chat. So I'll give you a few minutes to do that. Um, so the question for tonight is, how many stocks are compatible with iFlip's AI? There are thousands and thousands and thousands of stocks out there, but iFlip's AI doesn't work on all of them. We had this question on the mailbag about like how it definitely doesn't work on IPO because of the IPOs because of the lack of data. So how many stocks are compatible with iFlip's AI? If you've been paying attention and following us for a while, this might be an easy question. In other ways, this might be a difficult question because it's not Googleable. Um, now the now I'm going to bring Kelly back up for a second because the reality of this question is that it's always fluctuating, right? We're always fluctuating by like a few. And Kelly, you know the exact number because I asked you for this for today. But we'll give it to you if you're within like the tens, right? If you're within like if the answer is let's say 70, then if you're in the 70s, we'll say that you were correct, okay? Because it is constantly changing, so we will round for you. All right, so type in your answers in the chat here. We're getting some answers. We got a huge range of answers right now, 24 all the way up to 1,000. I'm not going to
It's
give you any
between
hints
those two
about
numbers. How about that?
it's, yeah, we'll just say it's in between those two numbers. That's the hint there. And while we're waiting for the answers, Kelly, I do have one last question for you. Just a quick comment. Um, we're still a lot of people are still forecasting a recession. And are you like, can you give us just brief breakdown of like, is the recession in 2023 that we're expecting, do you think it's going to be better or worse or the same as the one in 2008? And if you can just compare the two for us real quick.
Sure. I think most of the people out there probably see or already heard various pundits point out that the recession that comes here is nothing like the 2008 the recession that we know we went through. They called that the the Great Recession because it was almost a depression. This recession is totally different, I feel, and albeit it will be measured as a recession, I don't feel that it is going to be anything like 2008. And I also don't feel that we will be affected by it in the same way that we would see in previous recessions like the 91, the 2000, the 2001, the 2008, of course, and now what I think will occur this time. The main reason, of course, in 2008 was leverage. The one in early 2000 was due to a financial collapse in the technology stocks, and it was very brief. It was only one quarter. The 2008 was for over 3 quarters. This one, I think, would be maybe one, maybe 2 quarters. However, we're coming from a totally different place. We're coming from a place where the money in the system is flush. The system has a current huge amount of available cash, M1. M2 is shrinking, but M1 is still there. What I think will be totally different here is the recession will come as a result of lower growth because of layoffs. But it will not be felt in the same painful way for the general sect of the economy because goods and services are still are much bigger part of our economy than in 2008, as well as the fact that what's going on here is come after two things that have occurred. One, a massive input of government spending that created an inflation that has forced the Fed, especially in America, to raise interest rates to combat inflation at the expense in knowing that it will cause job cuts. So they know this. Will it be a soft landing? As much as I don't like the Federal Reserve or the way they behaved, I think they have a chance to create a soft landing in this case because the damage wasn't as deep as the previous recession I saw, especially of 2008 or early 2000 or the 1991 recession I saw after the Gulf War, 92 actually, with the spending there. So I don't think it's going to be as bad. I also feel that there's just nowhere near the leverage. The leverage was huge in 2008, and this time the leverage isn't an issue at all. This time it's just a simple combatant of inflation at the expense of some jobs. And even though I don't like the way they carry the metrics, but right now everybody should know we have had the lowest unemployment um, in recent history, even lower than when we had Donald Trump. But the metric is wrong in many ways because the participation rate is much, much lower.
Right.
So when you just add it all up, I feel it's sloppy, it's messy, but America will get through it. I think we have some problems ahead that we have to face. Inflation is still here. It's not going away. The Chinese economy is going to ramp up. I think that will pull prices down at some point, but not now, later in the year. And at the end of the day, yes, there will be a recession, but I don't think it's going to play that much of the big role on the stock prices and equity prices in 2023.
Gotcha. Thanks, Kelly. Perfect timing, too. Last call. You have about 5 more seconds to get your answers in for this trivia question because I'm actually going to have Kelly reveal the answer. Because, like I said, the number of stocks that the AI is compatible with, does fluctuate a little bit day by day. And so, Kelly, I'm pretty sure I know who the winner is here. But please give us the grand reveal. How many stocks as of today are compatible with the iFlip AI?
654.
654. That means that let's see. Our winner for tonight is Susan Lewis with 650. That's really
Wow.
close. That's really close. So I am very impressed by that, Susan. I have a hunch that that wasn't just a guess. I have a hunch that you knew that. Is that true? Sound off in the comments in the chat there, because you were damn close, right? I think when we've talked about this in other AI circles and other shows, we always said 650 because we always rounded it because it's always around there. So I mean, that's pretty much exact. So let me know. Did you know this, or was this a guess? Okay, so Susan, what did you win? Susan, you won the
Wow.
uh, the mastering the markets live recording. The event that we had in Dallas in October. It's a 2-day event. You've won the recording of that event that most people had to pay up to $500 to attend. So you're getting that $500 value absolutely free as your raffle prize. If you already have it, then let us know. We'll give you like a couple of months free on your subscription. So how do you qualify? This is for everybody. How do you qualify to receive the prize? It's not enough that you just answer the question. You also have to show us that you're invested in a smartfolio. It doesn't matter which one. I don't care which one. As long as you show us that you're invested in one smartfolio, you qualify for the prize. How do you show us? Well, you can. I'll let you know right here. Email mailbag at iflipinvest.com, and there's the email right there. All YouTube show related questions like raffle entries and that kind of stuff, all of that goes to mailbag at iflipinvest.com. Either Lee or I will see it, we'll verify it, and we'll qualify you and send you the credentials for the course right away. Did she answer? Just an educated guess. Wow. That is something else. Just an educated guess, she says. And it's right on the money too. All right. Well, that does it for tonight's episode of the AI Circle. Thank you so much for joining us this evening. Don't forget that next week we will have a special live training on entity structuring and taxes and all that kind of stuff, because a lot of that kind of stuff that's changing in 2023 and over the next few years. So don't miss out. We're having one of the speakers from Dallas come on live and do a special training with us. And you're getting that where most people have to pay for that. It was in such popular demand. We're doing that again for you absolutely free. So make sure you like and subscribe and follow us. Kelly, you had a final note?
Yeah, I did. I think I wanted everybody to keep an eye on the interest rate on the 10-year note. Those are at critical junctures as well. And they look, right now, they look like there's a chance that they could go a little bit lower in yield. So that'll be a conversation 2 weeks from now. And that will be, by the way, the very likely thing that will ultimately upend what I think is a short term rally.
Mm. Well, so there you have it.
2 weeks
At
from
the
now.
last minute, Kelly throws in another prediction, 10-year note. If you're a futures trader, that should be easy to keep an eye on. So make sure you keep an eye on that. That does it for now. We'll see you next week for the live training with Scott Arden. Make sure you like and subscribe and stay tuned for the next video from iFlip. Good night, everyone.
All the best.